Welcome to Chapter 15, Exchange Traded Funds. ETFs may be the most familiar product in the modern fund industry, but familiarity can create false confidence. An ETF is both a pooled investment portfolio and a security trading on an exchange. That means the investor must understand two markets, two prices, and a chain of institutions connecting the ticker on the screen to the assets inside the fund. In this chapter, we will trace creation and redemption, explain how authorized participants and market makers support price alignment, separate visible trading volume from underlying liquidity, and compare ETFs with open-end mutual funds. We will also examine premiums and discounts, tax mechanics, custom baskets, active and index products, bond ETFs, leveraged and inverse funds, defined outcome strategies, and the total cost of entering and exiting a position. The March 2020 bond market shock will show why an ETF discount can sometimes be price discovery rather than product failure. The final mini case will force us to choose between a lower expense ratio and a cleaner trade. ETFs are easy to buy. Understanding what you bought takes a little more work, which is generally how finance arranges things. An ETF has a market price and a net asset value, and those numbers are produced in different places. In the secondary market, investors trade existing ETF shares with one another through exchanges and brokers. The price moves continuously as buyers and sellers negotiate. In the primary market, authorized participants create or redeem large blocks of shares directly with the fund by delivering or receiving a basket of securities or cash. That second market is the bridge between the traded share and the underlying portfolio. By year-end 2025, United States ETF assets had reached about $13.4 trillion across roughly 4,495 products. Net issuance during 2025 was about $1.5 trillion, and nearly 19.8 million households owned ETFs. At that scale, the creation redemption system is not obscure plumbing. It is major market infrastructure. Arbitrage and competition normally keep the exchange price near portfolio value, but the relationship can widen when underlying markets are closed, securities are difficult to price, or dealer balance sheets become scarce. The ticker is the front door. The basket mechanism is the foundation. An ETF has two prices, two markets, and at least three people insisting it is simple. This chapter develops four practical abilities. First, trace the complete ETF mechanism. You should be able to follow an investor trade in the secondary market and then explain how market makers, authorized participants, baskets, and the fund interact in the primary market. Second, calculate and interpret implementation measures. That includes bid-ask spreads, premiums and discounts, tracking difference, market impact, and total holding period costs. Third, compare wrappers. You should be able to evaluate an ETF against an open-end mutual fund using pricing, liquidity, tax mechanics, distributions, fractional access, automatic investing, and investor behavior. Fourth, judge the product rather than merely recognizing the label. That requires analyzing the index or active process, holdings, derivatives, basket design, underlying liquidity, capacity, counterparties, taxes, and intended use. Notice the progression. We begin with mechanics, move to measurement, compare alternatives, and then make a recommendation. By the end, you should be able to explain an ETF as both an investment portfolio and a traded security. A ticker symbol is a useful label. It is not a due diligence memo, wearing 4 capital letters. 4 connected questions organize the chapter. First, how do the two markets work? Retail and institutional investors trade ETF shares on an exchange, while authorized participants create or redeem large blocks with the fund. Second, what links the price to the portfolio? Net asset value, intraday estimates, published baskets, market maker hedging, arbitrage cost, spreads, and premiums or discounts all contribute. Third, What exactly is the product? The ETF wrapper can contain an index strategy, an active portfolio, bonds, commodities, currencies, derivatives, leverage, inverse exposure, or option-based outcomes. Fourth, how should an investor use it? Exposure, order type, trading time, holding period, taxes, liquidity, rebalancing, total cost, and behavioral discipline all matter. The sequence is important. A student who starts with the ticker and the expense ratio can miss the exposure, the structure, and the trade. We will therefore move from market mechanics to pricing, from pricing to product design, and from product design to the investor decision. The wrapper changes implementation. It does not make the underlying risk disappear. Risk has never been especially impressed by attractive packaging. The ETF ecosystem contains several related roles that should not be collapsed into one. Investors buy and sell shares through brokers on an exchange. Market makers post bids and offers, manage inventory, hedge exposure, and compete to provide liquidity. Authorized participants have agreements that permit them to create or redeem large blocks directly with the fund. Some firms act as both market maker and authorized participant, but the jobs are not identical. The sponsor or advisor designs the exposure, manages the portfolio, publishes holdings or basket information, and oversees the operating model. The custodian safekeeps assets and settles baskets, while the fund accountant maintains the books and calculates net asset value. Exchanges and data vendors list the shares, disseminate quotes and trades, and support market transparency. The strength of the structure depends on competition, financing, hedging instruments, operational connectivity, and the liquidity of the underlying basket. If one authorized participant steps away, others may remain. If all hedging becomes expensive at the same time, quotes can widen quickly. Roles can overlap without becoming interchangeable. Two firms sharing the same office tower does not mean they share the same job description. Creation and redemption support price alignment through incentives, not through a mechanical guarantee. Suppose an ETF trades above the estimated value of its basket. Buy enough to cover trading, financing, taxes, and operational cost. A market maker or arbitrageur can hedge the exposure, and an authorized participant can assemble the creation basket. The authorized participant delivers those assets to the fund and receives a creation unit of ETF shares. Those shares can then be sold in the secondary market, increasing supply where the ETF is trading rich. The process reverses when the ETF trades at a meaningful discount. An authorized participant can buy ETF shares, redeem a creation unit, receive basket securities or cash, and sell or hedge those assets. In theory, that trade narrows the price gap. In practice, the arbitrageur must estimate the basket value, source securities, finance inventory, manage market movement, settle correctly, and accept uncertainty. If the expected profit is smaller than the spread, market impact, taxes, borrow cost, or operational risk, the gap can remain. Arbitrage is a business decision, not a charitable service performed for the educational value of the textbook. The mechanism works best when the basket is transparent, the underlying assets are liquid, and several firms can compete. Average daily volume is useful, but it is only one layer of ETF liquidity. The visible order book shows bids, offers, displayed size, depth, and recent trading in the ETF shares. Market maker capital determines how much inventory firms are willing to hold and how aggressively they can quote. Underlying liquidity matters because a market maker usually hedges or creates against the securities, futures, or other instruments in the basket. Creation capacity depends on authorized participants, custodians, settlement systems, financing, and the ability to source the required assets. Time and venue also matter. Spreads often widen at the market open, around major news near the close, or when foreign underlying markets are closed. Finally, investor order strategy can materially change cost. A patient limit order may receive a better result than an urgent market order, especially in a thin or volatile product. This is why a low volume ETF ETF can still be tradable when the underlying basket is liquid and several market makers compete. The reverse can also be true. A popular ticker can become expensive when its underlying assets are difficult to trade. Volume is a clue, not a verdict. The screen tells you what is traded. It does not promise what your $2 million order will cost. ETFs and open-end mutual funds can deliver similar portfolio exposure through different transaction models. An ETF trades intraday at bid and ask prices that may differ from net asset value. The investor can face a spread, market impact, a commission where applicable, and a premium or discount. In-kind redemptions can reduce the need for the fund to sell appreciated securities and may lower taxable capital gain distributions. Access generally requires a brokerage account, although many platforms now support fractional shares and recurring purchases. The flexibility is useful, but continuous trading can also invite unnecessary activity. An open-end mutual fund gives eligible purchases and redemptions the next calculated net asset value. There is no bid-ask spread, but loads, redemption charges, platform fees, taxes, and account costs may still apply. Mutual funds commonly support automatic dollar investing and retirement plan administration. Once daily pricing can reduce tactical trading, but it has never prevented investors from chasing performance with impressive enthusiasm. Neither wrapper is automatically superior. The better choice depends on the actual product, account structure, tax setting, holding period, trading needs, and investor behavior. Intraday liquidity is a feature. For some investors, it is also a temptation connected to Wi-Fi. The expense ratio is important because it repeats every year, but it is not the investor's complete cost. Ongoing cost includes the stated expense ratio, portfolio turnover, tracking difference, taxes inside the portfolio, cash drag, and any securities lending economics. Trading costs includes the bid-ask spread, order handling, commission where applicable, market impact, and movement caused by the investor's own order. A premium or discount can also change between purchase and sale. Finally, after-tax results depend on distributions, realized gains, account type, and holding period. The slide gives a useful scale comparison. A 5 basis point annual fee difference saves only 5 cents per $100 each year. A 40 basis point round-trip trading cost consumes 8 years of that annual saving. That does not mean trading cost always dominates. A long holding period can make recurring fees decisive. It means the analysis should match the expected use. Investors sometimes spend 20 minutes comparing 3 basis points, then cross a wide spread with a market order at the open. That is the financial equivalent of driving across town to save 2 cents per gallon and using half a tank to get there. Total cost begins with the exposure and ends after the exit, not at the expense ratio column. ETF baskets are more than a mechanical list of securities. A pro rata basket reflects the portfolio proportionally and is conceptually straightforward. A custom basket differs from a pro rata slice and can help manage liquidity, taxes, cash, rebalances, difficult securities, or portfolio transitions. In-kind transfers allow securities to move between an authorized participant and the fund without forcing the portfolio to buy or sell for every creation or redemption. Transaction fees can help protect existing shareholders from the cost of processing unusual baskets. Flexibility, however, creates governance responsibility. Written policies should define who can approve a custom basket, how it is valued, how conflicts are monitored, and how the fund prevents selective treatment from favoring an authorized participant or shifting costs to shareholders. Daily portfolio information, basket records, premium and discount data, and bid-ask information support transparency and review. The tax advantage often associated with ETFs is not magic generated by the ticker. It is partly the result of how appreciated securities can leave through in-kind redemptions and how baskets are managed. A custom basket is a portfolio management tool. it is not dealer's choice with shareholder assets. Efficiency improves only when discretion is paired with evidence, controls, and fair dealing. The word ETF describes how shares are delivered. It does not describe one investment strategy or one risk level. An index ETF may use full replication, sampling, derivatives, or a combination to track a benchmark. An active ETF gives a manager discretion within a stated mandate and usually provides daily holdings transparency or uses an approved alternative structure. A bond ETF trades continuously, even though many underlying bonds trade over the counter and only intermittently. Commodity and currency products may hold physical assets, futures, swaps, trusts, or partnership interests, each with different tax, role, collateral, and counterparty consequences. Leverage and inverse ETFs usually target a multiple or inverse of daily performance. The daily reset means a 2 times ETF is not promised to deliver twice the index return over a month or a year. Volatility and path can create very different results. Defined outcome ETFs use options to target buffers or caps over a specified outcome period. So entry date, holding period, path, and remaining protection matter. Buying every ETF with the same due diligence checklist is like evaluating every vehicle because it has 4 tires. The delivery wrapper may be similar. The exposure could be a commuter car, a cargo truck, or a dragster with a daily reset. The growth of the ETF market has been extraordinary. United States ETF assets increased from roughly $66 billion in 2000 to $301 billion in 2005, nearly $1 trillion in 2010, about $2.1 trillion in 2015, $5.4 trillion in 2020, and $13.4 trillion by year-end 2025. ETFs represented about 30% of investment company assets, supported by roughly 288 sponsors. Several forces produced that growth. Market appreciation increased existing balances. New cash moved into low-cost index exposure. Active ETFs sector and thematic products, bond portfolios, and specialized strategies. Advisors incorporated ETFs into model portfolios and tax management workflows. Broker commissions fell, fractional trading expanded, and platforms made ETF access easier. Mutual fund to ETF conversions also moved established assets into the wrapper. The chart shows scale, not automatic superiority. A large market can contain excellent products, redundant products, and strategies launched because the marketing department discovered another adjective. ETF growth demonstrates that the wrapper has become core infrastructure. It does not relieve the investor from checking exposure, cost, liquidity, and fit. The ETF began as a niche experiment and became a financial Swiss Army knife. As with a Swiss Army knife, not every attachment is equally useful. ETF history shows the wrapper evolving from a single broad market idea into an operating platform. In 1993, the SPDR S&P 500 ETF established the successful United States exchange-traded index model. During the next decade, bond, commodity, and hybrid products expanded the available exposures. Actively managed ETFs began operating in 2008 under individual exemptive relief. In 2019, Rule 6e11 created a more standardized regulatory framework for many ETFs, replacing much of the product-by-product exemptive process. The March 2020 bond market shock then became an important stress test. Bond ETF prices moved continuously, while many underlying bonds traded infrequently, highlighting both price discovery and the limits of stale valuation inputs. From 2021 through 2025, 191 mutual funds representing about $113 billion at conversion moved into ETF form. Each wave added convenience and raised new diligence questions. Today, the wrapper itself is mature. Competition increasingly depends on exposure quality, indexing rules, active process, tax efficiency, liquidity, distribution, and operational execution. And the first ETF helped investors trade the market. Modern ETFs can trade almost any idea somebody can fit into an index methodology, a derivatives book, or a marketing sentence. Innovation expands choice. It also expands the homework. The March 2020 bond market shock is one of the best examples of why premium and discount data require interpretation. As investors rushed for liquidity, dealers reduced balance sheet capacity, and many individual bonds traded infrequently. Fund accountants still needed end-of-day values, so evaluated prices sometimes relied on older transactions models or dealer inputs that lagged the price at which a large position could actually trade. Some bond ETFs therefore traded at unusually wide discounts to reported net asset value. It was tempting to describe the ETF as broken. In many cases, the ETF market price may have been incorporating current risk faster than the underlying bond marks. The screen was telling an uncomfortable truth before the valuation process caught up. Secondary market trading also allowed investors to transfer risk without every ETF sale forcing an immediate portfolio sale. None of this means every discount was harmless or every quote was fair. Wider spreads, uncertain baskets, financing limits, weak bond liquidity, and urgent market orders all increased investor costs. The correct question is not simply how far is price from NAV? It is how current and executable is the NAV input? What does the basket cost? And can arbitrage function at scale? During stress, NAV can arrive wearing yesterday's shoes. The ETF price may be messy, precisely because the market is updating in real time. This matrix separates exposure complexity from execution sensitivity. A broad United States equity ETF is generally easier to understand and usually trades against a deep, open underlying market. A core bond ETF may have a familiar objective, but greater execution sensitivity because the underlying securities trade over the counter and valuations can be less immediate. Emerging market ETFs add country, currency, time zone, settlement, and market access complexity. Active thematic ETFs can concentrate on a narrow story, change holdings quickly, and depend heavily on the manager's definitions and capacity. Defined outcome funds add options, buffers, caps, outcome periods, and entry date conditions. Leveraged and inverse products sit near the high complexity, high sensitivity corner because daily reset, compounding, volatility, and trading behavior all affect results. The positions are not permanent. A highly liquid emerging market ETF can trade better than a small domestic thematic fund. The point is to ask two different questions. Do I understand the economic exposure? And can I implement it efficiently under the expected market conditions? A product can be simple to buy and difficult to hold correctly. The buy button has never been required to administer a comprehension test. A disciplined ETF review begins with the exposure, not the ticker. Step 1 is exposure. Identify the economic risk and the index, model, or manager defining it. Step 2 is the portfolio. Review holdings, concentration, sampling, derivatives, collateral, turnover, rebalancing, and capacity. Step 3 is structure. Determine whether the product is a registered fund, commodity pool, grant or trust, note, or another vehicle, and understand tax treatment, basket policy, and counterparty roles. Step 4 is liquidity. Examine the ETF spread and depth, the underlying market, authorized participants, market makers, time zones, financing, and stress behavior. Step 5 is cost. Combine the expense ratio with tracking difference, spread, impact, premium, or discount risk, taxes, platform charges, and expected turnover. Step 6 is use. Define the account, holding period, order type, rebalancing rule, monitoring trigger, and behavioral guardrail. This sequence prevents a common error, finding a cheap ticker before deciding what exposure is actually needed. A good ETF can be a poor trade. A good trade can still deliver the wrong exposure. And a correct exposure can become a poor investment if the investor uses it as a substitute for a personality test every time the market moves. Now apply the framework to a $2 million transition from an active international mutual fund. ETF A charges 8 basis points, trades about $250 million per day, and has a typical 4 basis point spread. ETF B charges 4 basis points, trades only about $3 million per day, has a 22 basis point spread, and tracks a slightly different index. The client expects to hold for 5 years, wants minimal tracking disruption, and several underlying Asian markets are closed during the proposed United States trade. Begin with exposure. Country weights, index construction, rebalancing rules, and treatment of emerging markets may create a larger difference than 4 basis points of fee. Next, calculate. ETFB saves 4 basis points per year, or about $800 annually on $2 million. The difference in quoted spreads is 18 basis points. Using half spread as the simplified entry cost, B costs roughly 9 basis points more to buy, or about $1,800, implying about 2¼ years to recover through fee savings. If similar spreads apply on the eventual exit, the simplified round trip difference is 18 basis points or $3,600, requiring about 4½ years. That is uncomfortably close to the 5-year horizon before market impact, tax, and index mismatch. The trade should use limits and institutional desk support. With quotes from multiple liquidity providers and explicit attention to closed underlying markets. Based only on the evidence provided, ETFA has the stronger implementation case. The cheapest expense ratio wins the spreadsheet quickly. The actual portfolio may take longer to agree. Pause the presentation and answer these 4 questions before checking the speaker notes. Question 1. Who transacts directly with an ETF in creation units? Is it every retail investor, an authorized participant, the benchmark provider, or the auditor? Question 2. What is an ETF premium? Is it the management fee, a market price above a relevant value measure such as net asset value, a guaranteed return, or a dividend reinvestment? Question 3. Why can a low volume ETF still be liquid? Is it because volume never matters, because market makers can access a liquid underlying basket and create shares, because net asset value is fixed, or because the sponsor guarantees a bid? Question 4. What does a leveraged ETF usually target? A multiple of long-term index return, a multiple of daily index return, a fixed annual coupon, or no volatility? Pause the video now and write 1 sentence explaining each answer. Do not settle for the correct letter. The explanation is the useful part. When you review the notes, remember the central ideas. Authorized participants. Access the primary market. Premiums compare market price with portfolio value. Liquidity has more than one layer, and leveraged products generally reset daily. 4 questions, 4 chances to prevent a very expensive misunderstanding later. Carry 6 claims forward. First, ETFs have 2 markets: secondary trading and primary creation or redemption, jointly shape price and liquidity. Second, liquidity has layers: the order book, market makers, authorized participants, underlying securities, financing, time zones, and order strategy all matter. Third, price can differ from net asset value. Premiums and discounts reflect valuation timing, uncertainty, arbitrage cost, and market conditions. Fourth, the wrapper is not the exposure. Index, active, bond, commodity, leveraged, inverse, and option-based ETFs can carry very different risks. Fifth, total cost includes the trade, spread, impact, premium or discount change, tracking difference, tax, and recurring fees all affect the result. Sixth, use requires discipline. Choose the exposure, structure, timing, order type, holding period, rebalancing rule, and monitoring trigger deliberately. The mature ETF market gives investors extraordinary choice and efficient tools. It also makes it easy to confuse product access with investment understanding. The wrapper is convenient. The risk did not read the marketing brochure. In the next chapter, we move from registered daily liquidity products to hedge funds, where leverage, fees, valuation, and liquidity are negotiated more directly. The products become less standardized, and the due diligence becomes even less optional. This final page is the refresh register for Chapter 15. Posen and Hamacher provide the operating architecture. Investment Company Institute materials supply current market totals, ownership data, issuance, sponsor counts, conversions, and historical context. Rule 6, C11, and the Securities and Exchange Commission Compliance Guide define the standardized regulatory framework, basket policies, disclosure, and record-keeping expectations. Investor.gov and FINRA materials explain product mechanics and investor risks. Federal Reserve and market functioning research provide context for the March 2020 bond market stress. Do not read the long web addresses aloud. Instead, notice what each source can establish. Official rules define legal requirements. Industry data describe scale and trends. Market studies help interpret stress behavior. None of these sources proves that a specific ETF is appropriate for a particular investor, or that a quoted spread will be available for a large trade. That conclusion requires current holdings, index rules, tax circumstances, market conditions, live quotes, and a documented use case. The durable questions remain: what exposure is inside the wrapper? Who can create or redeem? How liquid is the basket? What does the trade cost? What can cause price and value to diverge? And what investor behavior can turn flexibility into harm? Chapter 16 now changes the contract entirely, moving into privately offered hedge funds with negotiated leverage, fees, and liquidity.